Hello there. Welcome to Trading Day. Let's get to the big stories we're bringing you from the BNN Bloomberg newsroom. Canadian inflation cooled last month, but the decline was less than expected. The year-over-year rate was 2.2%. There was a faster yearly decrease in gasoline prices, and housing costs, however, were a major contributor to monthly price pressures. Grocery prices saw the biggest monthly drop in more than 5 years. Some economists think the latest figures reinforce the Bank of Canada's view that interest rates can stay put for now. Prime Minister Mark Carney's government faces a confidence vote on its budget today. The budget proposes spending increases for defense, housing, and infrastructure. It also envisages a deficit of almost $80 billion in 2025-26. To avoid a new election in the vote, the Liberals need at least 2 votes from opposition members or 4 members abstaining. Shares in Novo Nordisk edging higher today. That Danish pharmaceutical giant is cutting the price of its blockbuster products Wegovy and Ozempic for existing cash-paying patients in the US. This move undercuts rival Eli Lilly. Novo says doses of the popular weight loss and diabetes drugs will be available for 30% less than their current prices. Those cuts are geared toward making its drugs more competitive with copycat medicines and products from Lilly. Canadian stocks are benchmark index under a little pressure right now. And let's have a look at US markets. They slipped at the open, then they strengthened during the morning, and you can see they are marginally down right now. So we have an atmosphere of skepticism in the tech market. The Wall Street Journal, for example, noting that CoreWeave, which has plenty of debt, has seen its stock declining rapidly over the past week, still well up from its IPO. That is a computer equipment and services darling. Let's get more on this malaise in tech stocks, lots of them off their highs, including Meta. We're joined by Sam Labelle, Portfolio Manager at Veritas Asset Management. Sam, great to see you. Maybe you could put up a 1-year chart for the NASDAQ 100 as a proxy for the big techs. What do you think? Have they hit a wall here, or is it just a blip? I know that's essentially an impossible question to answer.
Well, one of the things that's going on is we're living through a very unusual period here. We've had a government shutdown, taken away all of the economic data that we usually rely on. Retail sales, GDP, all of these things will be delayed. So with that uncertainty, it's hard to tell what's actually going on in the underlying economy. It's hard to tell whether we're having a normal slowdown, whether we're having the after effects of the government shutdown. A lot of economists believe that government shutdown because it took away people's paychecks. It took away the paychecks of the direct employees and the contractors. They think that's going to shave 1 to 2% off the annualized GDP number for Q4. So the market is rightly thinking, well, if GDP slows, what about all these high valuations for tech companies? Are the income flows into equities going to slow? Because if people aren't getting their paychecks, they're not paying their 401k contributions, there's a slowdown of inflows into the equity markets. And so when we think about these tech valuations, I believe, and they require new blood all the time. In other words, they've got to have people moving money into the market to continue to bid up the price of the valuations. And so to the extent that that will slow or the economy starts to falter a little bit, there is a correction that can happen. Obviously, everyone who looks at these metrics has to have a view both on the growth rate of the tech earnings, the growth rate of investment into AI, the growth rate of chip spending. All of these things go into the compress, so to speak, to decide what are we going to pay for these valuations. But if fundamentally there's no cash moving into the markets, or if cash is sort of retreating from the markets, then it's really hard to sustain things that are mostly based on hopes and dreams about where we'll be in 10 years in the tech world. So we are cautious on the AI space. We think that there will actually be a fair amount of weakness coming in Q4. We have no data to go on, but we will get some really key bellwether earnings this week out of the big retailers in the States. For example, Walmart, Target, Home Depot, Lowe's, TJX, all of these retailers with October 31st quarter end. So that October 31st date will have at least a month worth of the slowdown from the government shutdown in the US. And again, that's stretched into Q4. So we're expecting weak retail numbers expressed by the earnings of those companies, and potentially a reduction in guidance going into Q4. And the biggest challenge is that you won't be able to tell whether that's just government shutdown or there's a greater malaise kind of settling in on the consumer due to tariffs, due to all of the different factors that are at play. And for that reason, the uncertainty really isn't good for markets. So here you might be dialing back risk just on the lack of data and the lack of confidence in what might happen in the next couple months.
You have some stock ideas for us, and it's interesting. People sometimes say, well, just buy the Brookfields, because generally they've had pretty good returns over the years. But you're avoiding the biggies, Brookfield Asset Management and Brookfield Corp right now. But you do like the look of Brookfield Infrastructure. Start off with why you're, before we talk about Brookfield Infrastructure, tell us why you're cautious on BAM and BN, please.
So really the model for BAM, for Brookfield Asset Management, BAM, and Brookfield Corporation, BN, the model is to get capital, make great investments that exceed the cost of that capital, and return in a leveraged way the returns to shareholders. The challenge is when the market slows or the capital markets slow down, that capital slows down, the cost of the capital goes up a little bit, and we're seeing, for example, credit spreads are narrowing. So that's a big factor when you're considering what kind of returns you can get off your investments. We're seeing peers in the US of those of BAM and BN, they've been squeezed quite a bit harder on valuation. And it's kind of a catch up that we would expect BAM and BN to experience here to the US peers. So we're avoiding that for now. There have been some bubbling up of private credit issues. We're not seeing any of that specifically at BAM or BN yet, but with those concerns, kind of the discount rate goes up. So we kind of avoiding those names just on the fact that they have a premium valuation that can get hurt in a retreat on valuation. We do like the Brookfield Infrastructure. You're getting double-digit FFO with the funds from operations. That looks like it's going to grow double digits. They've done a really good job of investing and recycling some of their projects. So they buy, invest, and then sell at a premium some of their assets. They're starting to gain interest on the utilities interest because AI will require a lot of new utilities investment, and they're well positioned to do that. So we like that as an option, and it's a good yielding play.
You have another couple of stock ideas for us. Bombardier, they're seen now as a potential defense play. They could well get some of the money we're going to be spending on weapons. Yeah,
we've seen some interesting talks happening over Swedish fighter jets, and maybe there'll be a mix there. I mean, when the government makes decisions on defense spending, they do look for what kind of industrial benefits it can create for Canada. And, buying F-35s doesn't necessarily do a lot for our industrial complex, but we could potentially mix in some of these other fighter jets. We would expect that Bombardier would be an excellent bidder in some of that contract work. So there is some interest increasing there, but fundamentally their order backlog is very strong and they're growing in the aftermarket business. So there's still some room here for the multiple to expand a bit. And the cash flows have been improving for the last couple of years. So we like the name.
And finally, we're tight for time, but CP Kansas City, people were worried that tariffs would disrupt cross-border trade. We saw weakness in those stocks, but you like this rail carrier.
Yeah, ultimately, you're still going to get low double-digit EPS growth next year. The multiple has retreated back towards peers, so you're not paying a huge premium for CP. And our bottom line expectation here is that there's not going to be a crash in the economy in 26. We think the real economy will likely hold up, even with some of the tariffs slowing a bit of activity. The consumer in the U.S. effectively is paying a tax on some of their consumption through the tariff, but we don't expect that the consumption is going to collapse. And with interest rates coming down, there's a number of interesting sector plays that could happen if interest rates and long-term mortgages in the U.S. come down. The home building industry picks back up. There's increased spending. So there's a lot of benefits here that could happen just from a weaker economy combined with lower interest rates that can help a stock like CP.
Thank you very much, Sam. It's great talking to you as ever.
Thank you.
Sam Labelle, Portfolio Manager at Veritas Asset Management. Up next, Statistics Canada says lower prices for gasoline and slower rises in groceries contributed to a slight decrease in headline inflation, bringing it down to 2.2% in October. We'll discuss what this means for the Bank of Canada's rate cutting cycle. This is after the break. Inflation data for October revealed a relatively tame headline rate of 2.2%, mainly driven by month-over-month lower prices for gasoline and groceries. Our guest thinks that rate cutting by the Bank of Canada will continue after a pause. He reckons the economic outlook for this country is weak. We're joined by Constantin Burma, Head of Fixed Income and Portfolio Manager at Mackenzie Investments. Constantin, great to see you. Thanks very much indeed for joining us.
Great to see you again.
So has the Bank of Canada essentially succeeded in taming inflation? I mean, 2.2% headline rate doesn't sound too bad.
Yeah, I think this sounds pretty good. I mean, this if I look into the details, there's nothing really that strikes me as a major reason for concern. Like the areas where things are looking a little bit hotter is still in shelter, and shelter, maybe if you break that down, the area that looks highest or hottest is in rent.
Mm-hmm.
That seems to be a little bit odd given what is happening in the country and the anecdotal evidence that I think we're all seeing and hearing in the newspapers of how the housing market is slowing down. But nonetheless, rent is still hot at over 5% year-over-year growth, and also on the month-over-month figure that was a 0.9, and that is a pretty big weight in the index, so that contributed a lot. And then on the negative side, I just heard it in the intro, but that's the obvious one. Gasoline prices went down. They will probably go up next month because that's how the spot market is already trading, but that is a very volatile component anyway, so we shouldn't probably read too much into that. And the other one is vegetables. I have not seen that at this supermarket, that vegetables are getting meaningfully cheaper, but if the Stats Canada is saying so, then
right. Yeah, you broke up a bit there on the audio, but I think we got the gist of it. Yeah, I know that Citi was surprised. The economists at Citi were surprised to see the strength in rents as well, given overall softness in the housing market. Are you in the camp, Constantin, that thinks the Bank of Canada will pause the interest rate cuts in December?
Yeah, I do think they will pause. So that seems very, very likely. If I look at what is priced in by the market, there's actually no rate cuts for the next year priced, also no hikes. So it is basically just flat. Nothing is expected from the bank for the next 12 months. I don't think that's going to be the case. I see that there's weakness in several key areas of the Canadian economy, and the key areas that I'm looking at is housing. That has been a massive driver for growth over the past years to decades, and we have immigration, as we probably also all know, has come down quite aggressively, and that is another big engine that the Canadian economy had over the past few years that is stuttering. And the other big ones are natural resources. Yes, I see some signs that there's something picking up there with the government's plans, but it is not of the magnitude that can compensate for the drag that we're getting from immigration and from housing. So I think that economic prospects for Canada, unfortunately, are going to be somewhat challenged for the next few quarters, and that will likely bring Bank of Canada back into the game.
It's great to have you here to give us a pulse check on the Canadian market. You broadly like Canadian bonds. And of course, if you're seeing a soft economy, bonds are likely to do well there in the sense that inflation isn't as much of a threat. But you have some credit concerns. So you'd rather be in shorter maturities. So does that mean that for Canadian government bonds even, you see international investors maybe looking askance?
Yeah, it's not a real credit concern that I'm super worried about the Canadian credit. But in global comparison, we have to look how are countries positioned, what is their financial positioning, what are rating agencies also saying about the different countries, what is the overall credit risk profile that countries have. And I would say that over the last few years, the Canadian credit profile has deteriorated. It is still prime, still AAA. It looks good on paper, but when we're going into a somewhat more difficult economic situation, countercyclical policies, so that means spending more to support the economy to bring it back on track, that could create a negative impact on how international investors would look at Canada. And the way that that is expressed, in my view, would be through the back end of the curve. So that is a steeper yield curve. So I like a lot of things about Canada at the front end. So anything up until 10 years. And when it comes to 20-year, 30-year bonds, I'm not running away from them, but I do have we have in our portfolios an underweight position in 30-year Canadian bonds, because there is a little bit of a higher risk that the international community will demand a slightly higher premium for that.
And we're tight for time, but I'm not sure if you saw that Bloomberg story that Jeffrey Gundlach, who's a renowned bond investor in the States, telling their podcast, Odd Lots, that he thinks there's garbage lending in private debt south of the border. Do you think that people have been a little reckless or taking too much risk?
Yes, so I read that. I'm also big fan of Odd Lots podcast, so that's a regular on my list as well. I do share some of those same concerns, and it is, things can stay in a limbo state for quite some time, but as we've seen also over the past few months, there has been some companies that blew up that were perceived as reasonably decent quality just a few months prior, and then bankruptcy or at least severe downdraft in their bond prices proceeded after some weak earnings results or some revelation of some news. So I also believe that there is more of that around. The question is whether they will come to the surface and whether that is happening right here, right now. The market is somewhat fragile. The amount of news that are floating around on weak credits in the US, in the private debt market, has picked up quite a bit. So it is a fragile environment. If we get one or two more of those names popping up, there could be a sentiment change in the market around.
Thank you very much, Konstantin. Great hearing from you. That's Konstantin Bermer, Head of Fixed Income and Portfolio Manager at Mackenzie Investments. Young people in Canada are increasingly falling victim to financial fraud. Apparently, they've surpassed seniors for the first time since 2006 in that respect. We'll have more after the break. Big promotional shopping days. Black Friday and Cyber Monday are just around the corner. And of course, holiday shopping will soon be kicking into high gear. This year, though, it appears trade uncertainty may be forcing Canadians to tighten their belts. CTV's Scott Hurst has more.
It appears tariffs may have a whole lot of us feeling more like the Grinch this year, cutting into our holiday spirit, but also cutting into our holiday budgets. A just-released BMO survey shows 3 in 5 Canadians are planning to adjust their holiday spending plans because of tariff concerns. Here's a closer look at some of the numbers. 37% of respondents are trying to buy more gifts with a minimal impact of tariffs, including purchasing goods made in Canada. About 25% started their holiday shopping earlier to avoid potential price increases, and about 15%, however, are budgeting to spend more on gifts in anticipation of higher prices. And ultimately, at the end of the holiday season, that big price tag is often a stressful affair. Those post-holiday credit card bills can be terrifying at times. Canadians, according to the BMO survey, are planning to spend an average of just over $2,300 this holiday season. That's not just gifts. It includes travel plans and accommodation as well, plus food and drink and decorations. From big ticket items to a few smaller things here and there, it can quickly add up, and that's where the stress comes in. About half of respondents say just thinking about holiday spending causes financial stress, and just over a third say they feel pressure this time of year to keep up with other families' spending, even if they can't afford it. And on average, Canadians believe it'll take them more than 2 months to pay off those holiday bills, and about 1 in 10 are not sure when or if they'll be able to pay off those mounting totals. So holiday cheer, yes, but mixed with a whole lot of financial anxiety as Canadians are feeling the pinch of not just the overall high cost of living, but the impact of tariffs and what it might mean for their holiday spending. Scott Hurst.
Okay, let's look at this vulnerability of young Canadians to fraud. Many young people strapped for cash. They're facing the bleakest job market in decades, and lots are falling victim to financial fraudsters. Bloomberg's Ari Alstetter looked into this growing problem. Ari, thanks very much for joining us. What kind of scams are young people falling for?
Well, these are often investment scams. These young people are approached by people who say they have a surefire way to invest their money and grow their money. And it's often through cryptocurrencies, crypto assets that they convince the young people to put their money in, at least at first. Sometimes the ultimate asset, it can be anything else. Sometimes it can be, well, we're going to invest your money in stocks. Sometimes we're going to invest your money in a new venture in Asia. But usually the first step is they say, well, you got to put your money in cryptocurrency first. Young people can be naive. They may not understand. Cryptocurrency is, of course, very good for scammers because it's easy to move the money untraceably between borders. So the ultimate destination of the investment, supposed investment, can vary, but usually the first stop is crypto.
Isn't it amazing how crypto comes up so frequently? I mean, the name means secret currency, but the industry says, "Oh, we're monitored," but it does seem to be a favorite of the fraud artists.
Yes, that's right. And often law enforcement has found these fraudsters. They're not based in Canada. They're often, I spoke to one law enforcement official, called them an international organized crime conglomerate. So the ultimate destination of the money can be far outside our borders. The people that these individuals are speaking to on the phone or over chats online can also be far outside our borders, often, outside of the place that they say they are calling from originally themselves. So it makes it very, very hard for law enforcement to bring these fraudsters to justice, to mount an investigation or prosecution, but also very hard to get the money back. And crypto only makes that more difficult because it's so hard to trace. It's much harder to trace crypto than if you were to just do a bank transfer or some other traditional form of moving money around.
I sometimes wonder how much value to society do cryptocurrencies add if they're so useful for drug dealers and fraud artists. But anyway, that's another day's debate. You talk about one woman who was ripped off by a platform called Pure Vision Trader, got her to invest in stocks. And apparently they had multiple videos on YouTube. So we see the internet giants helping these fraud artists. Of course, they say, well, we can't monitor every ad.
Right. These scams, they often find that they become quite sophisticated. They find all sorts of ways to make themselves appear much more legitimate. This one group, Pure Vision Trader, that this woman I spoke to invested in, they had what appeared to be a very legitimate investment platform online that you could make login credentials for, go on and monitor what appeared to be your investment. And to supplement this further, if you Googled it, you could find press releases announcing new features for this company. And as you say, on YouTube, there are all sorts of videos with sort of, I suppose, flash-looking animations. Who knows? Maybe they're generated by AI. With a very respectable-sounding voiceover saying about the revolutionary new features that this platform promised. So all sorts of ways that if you were to do some research of your own, at least superficially, you would see some things that made it look like a legitimate platform. And it was only after the fact that this young woman discovered that she couldn't get her money back, and it all seemed to be a scam. Canadian securities regulators since put out a warning about this platform. The websites have seemed to have gone offline, but new sort of fronts, I guess you could say, or scams seem to be popping up all the time.
We'd better jump, Ari. Great story. Thank you very much indeed. Bloomberg's Ari Alstadter. After the break, we'll bring you the latest headlines. Canadian inflation slowed a little bit last month. Data from StatsCan indicates that the rate of inflation in the Consumer Price Index dropped to 2.2% in October. It was a little higher than the economists had been expecting. They were looking for a rate of 2.1%. StatsCan says the deceleration was driven by cheaper gasoline and groceries. The agency notes, however, there was a rare increase in cellular service costs. They went up more than 7%, but it's said to be the segment's first price hike since April of 2023. We're watching shares in TransAlta today. That stock's had a great run over the past year, up almost 40%. The company will acquire an outfit called Far North Power and its 4 natural gas facilities in Ontario. The deal is worth $95 million, and it's expected to deliver an immediate boost to TransAlta's free cash flow. TransAlta says it's aiming to seamlessly integrate the new assets while remaining focused on advancing data center opportunities in Alberta. Shares in Johnson & Johnson edging higher. That's after the company agreed to buy an outfit called Halda Therapeutics in a cash deal worth more than $3 billion US. Halda is testing a new type of oral therapy as well as other treatments for multiple cancer types. Johnson & Johnson has been trying to boost its pipeline as well as deal with declining sales amid competition from cheaper alternatives. And we're seeing some selling in the North American markets. Today there are ongoing misgivings among some investors that the AI frenzy has gone too far. And of course, we are seeing some signs of speculative froth in the markets, including the launch of more and more of these leveraged ETFs. Apparently, some quintuple leveraged beasts may be on the way. And there's the TSX also down. No great pattern emerging right now in Toronto trading. We're seeing a little bit of strength in Enbridge. Of course, they just announced a major spending plan last week. Royal Bank flat, Canadian Natural edging higher. 80% of people who live without electricity are in Africa. It's a fact that has long hobbled the continent's industrial development. So why isn't Africa getting the energy it needs? And might that soon change? This week's Bloomberg Doc seeks to answer those questions.
About 80% of the global population without electricity live on a single continent.
Satellite imagery of African cities compared to satellite imagery of Western cities at night. You can see the darkness versus the light.
This lack of power matters. Electricity consumption and GDP growth are closely linked. In fact, virtually every wealthy nation on the planet uses power abundantly. And this isn't just about keeping the lights on, it's about economic independence.
Electricity is a fundamental right. Without that, you can't have health, education, anything delivered.
It also holds back industrialization.
Pretty much any other country in the history of the world, the way they got rich is via industrialization.
And mass production with its assembly lines.
That all happened because they had power of one sort or another.
And that's been true for everyone, from the UK to the US to more recently the likes of Singapore, Taiwan and South Korea. But why isn't Africa, the continent with the most sunshine hours in the world, getting the energy it needs for its own industrial revolution? Finding the cash for vast energy projects is one thing.
The size of investment is a hurdle. It's huge.
A country needs 1,000 to 2,000 kilowatt hours of energy per person per year to take off. And in many African countries,
that number is at less than 200 kilowatt hours per person per year. So we're way off in terms of where we need to be.
To say Africa is energy poor is in many ways a mischaracterization. The continent is incredibly rich in natural resources.
The share of minerals globally, Africa is home to around 30%. If it comes to crude and gas in particular, we're looking around 10%. There's enormous potential on the hydropower side. Solar is also untapped.
There's also a substantial labor force.
1.5 billion people, median age in Africa is 19. This giant young workforce to power the future.
But despite its vast potential, Africa's lack of functioning energy infrastructure brings huge challenges for industry.
We are using some world-class inspection machine, like as you can see there, body defect, all are rejected.
In places like Nigeria, the most populous country in Africa, there just isn't enough power being generated or distributed. Manufacturers have been forced to essentially abandon the grid.
Beta Glass, a top performer on Nigeria's stock exchange, which produces packaging for Budweiser, Coca-Cola and Heineken, has been forced to do just that.
You know, right, we cannot connect to national grid because frequently we are having power failure. Because of that, we are having different sorts of power backup,
including liquefied natural gas delivered by tanker and a solar power plant mounted on the roof. These backups are helping scale the business, but they're a luxury only a large company can afford. Across much of Africa, smaller firms are instead using these.
A country can't industrialize using diesel power generators because it's expensive. It's a very expensive option with which to operate factories, and it makes you uncompetitive.
It's just not sufficient to do mass industrialization, mass manufacturing. It's not the kind of thing that can power enough to generate the kind of jobs that the next billion Africans need.
The choice between unreliable energy or expensive energy is hampering African industry. The continent accounts for just 1% of global manufactured exports. But if energy access is so crucial for industrialization, why isn't more being done to fix the problem?
Investment is an issue. It's got huge sunk costs and long payment schedules.
Other factors are political risk and corruption. These are major inhibitors for investment because it's tough to get past Western compliance rules in order to invest.
Governance and political stability. If you're an investor and you're looking to invest in those countries and there's a change in administration, you're concerned whether the contract you signed would be adhered to.
This is a major issue when considering that most financing for energy projects comes from the commercial sector. On top of that, loans to African countries come with what many regard as unjustifiably high interest rates, far higher than countries with similar debt-to-GDP ratios.
Why should African countries borrow so expensive as compared to its peers in other parts of the world?
In spite of many of these hurdles, some African nations are still pressing ahead with massive power projects. And this 500-foot wall of reinforced concrete is one of the most ambitious, the Grand Ethiopian Renaissance Dam.
ኢትዮጵያ ህዳሴን የሰራችው ለመበልጸግ አካባቢውን በብርሃን ለመምራት የጥቁር ህዝብ ታሪክ ለመቀየር እንጂ በፍጹም ወንድሞቿን ለመጉዳት ስላልሆነ
Construction began in 2011 and has been plagued by delays and strong opposition from Egypt, which sits downstream.
It's Africa's largest hydroelectric powered dam, so it's quite a huge achievement for the continent and Ethiopia in particular. Their plan is also to export to their neighbors.
Danya Bayeni and Abanesha Sefa are two of the over 60 million Ethiopians who live without power. They hope the dam will bring electricity to their home.
ያው ማብራት ብኖር ያው ሳትጨናበስ ምን ሳትል ማለት ነው ይሰራል። እንጨት ራሱ ወይኔ አይነድልህም። በተለይ በቃ ይሄ ክረምት ውስጥ ደግሞ በጣም አስቸጋሪ ነው።
The couple even gave money to help fund the construction through a government program.
ይገንባ ግድቡ አባይ በሀገር ለ8100 ኤብሎ 3 ብር ስልኩ
It made it into kind of like a nationalist project where people donated, people bought domestic bonds.
Civil servants were also encouraged to contribute, as well as the vast diaspora that Ethiopia has. It's something they're very proud of.
በወንድ ለመግዛት ለኛ ደስተኛ ነን። በግል ሲጠይቁን ምን ወደ ኋላ ያለ ነገር የለም ገዝተናል። የገዛበትን ደግሞ ተሰርቶ ማለቁ ለኛ ደስተኛ ነው።
Funding energy infrastructure through crowdsourcing is just one way Africans are taking energy security into their own hands. Green technology is another. The continent has some of the best potential solar sites worldwide. And from Nigeria to South Africa and Morocco, solar panels are now being imported from China at a rapid rate.
There's actually a significant increase in the 12 months to June, amounted in total to around 15 gigawatts of solar panels that were imported, demonstrating the demand for power. Is it transformational? Absolutely, particularly for rural areas where national grids do not extend to.
At a step above that, governments are starting to partner with private companies to do mini grids. These are small power plants that could be renewable and will power, say, a neighborhood or an industrial estate.
And just introducing power to that agricultural rural community just helps in terms of the multiplier effect of allowing other businesses to emerge.
This is partly why the World Bank has launched an initiative to get power to 300 million Africans by 2030. The investment comes with a caveat. Countries must choose the lowest cost solutions, which are almost always renewable.
So we can connect 300, 600 million people into power in no time at all. We don't need to build cables. We don't need to have trucks to move diesel around. We just need to put it on their house and build it.
But some argue that the broader push to prioritise green energy by international institutions and policymakers has made it difficult for African countries to obtain funding for fossil fuel-based projects.
Il y a eu ce que j'ai appelé le fanatisme climatique.
This has irked many African leaders who want fuel, any fuel, to help lift their nations out of poverty.
Il faut donc que l'Afrique puisse continuer à exploiter ses ressources naturelles pour se développer, pour s'industrialiser.
When we consider what was agreed in Paris 2015, which was a restriction placed on future emissions, which African countries found unfair.
It's not going to bring a just transition to people around the world.
This idea that Western countries could get rich by burning fossil fuels, but Africa should learn from those mistakes, strikes a lot of people as condescending and hypocritical.
Solving Africa's energy insecurity may seem like the continent's problem, but the knock-on effects of an electrified Africa will be global.
If there are jobs in Africa, if there is hope for the future, you're far less likely to find young African citizens wanting to leave.
An energy-secure Africa would create a more secure world. We've got a massive group of young people, and yet there isn't a manufacturing sector that's available to absorb them.
Starting the workers being dominated by local employees means if I move to another factory, I take my experience to here in Africa. So I don't take it to another countries.
It's in the interest of everyone around the world that the last continent that hasn't gone through an industrial revolution does. The argument you'd hear from many African policymakers is whether it's through burning fossil fuels or through some kind of green energy transition, they don't think that matters as much as the fact that it needs to happen.
Up next, Canada's housing market showing signs of life, but year over year, still in a slump. Home sales in October were down year over year, but there's optimism about more activity in the new year. Let's get more from our own Lindsay Biscaya. Lindsay.
Yeah, so they're down year over year, as you say, but the optimism comes from the fact that they're up month over month. So we'll go through the numbers because it varies depending on how you're looking at it. When you're looking at year over year, last month, Canada just saw over 42,000 homes sold. So that's down 4.3% compared to October of 2024. Prices were also lower compared to October of last year. New listings were up, though, up 7.2% from October of last year. But then if you switch and you start looking at what was happening month to month, so this October compared to this September, you're seeing a bit of a reversal there. Home sales up by 0.9% on a monthly basis. That's the sixth consecutive increase over the past 7 months, giving some people some optimism. New listings were down month over month, though, by 1.4%. And then the price of a home went up slightly month over month.
That's it. But the price, the national price, still down. I think you may have mentioned this, something like 3% year over year.
Exactly. Yeah. So when we're talking about the benchmark home price, it was down, as you say, 3% year over year. It was up, though, 0.2% month over month. So it depends how you want to look at it. The average price of a home, $690,000. So again, depends on the market. Toronto, Vancouver, and Calgary, for example, all saw prices drop year over year. Montreal, though, saw almost a 7% increase. And we don't have a specific number in terms of whether that's homes or condos, but you were having a really interesting conversation earlier with Phil Soper from Royal LePage, talking about Canada's largest real estate market, Toronto, of course, and the condo market here and what people are really not looking for these days. Take a listen.
We're finding selling in the condominium sector are condominiums with parking. And you think, well, don't most condominiums come with parking? Well, yeah, if you live outside of downtown Toronto or potentially Vancouver. But for a period of time over the last 15 years, that was a really popular form of condominium. And well, we're not Manhattan, and people do still work partially in the office, partially out of the work, despite back to office mandates, which means they want transportation to get out of the city when they are not, living and working downtown.
So just an interesting anecdote there. People have standards when it comes to what they're looking for, but many economists think that the new year holds good things, that we'll see kind of a modest uptick in terms of people looking to get into the housing market, and that's because of lower borrowing costs. Of course, we're seeing prices of homes drop as well. That may help people who were maybe hesitant for quite a while think about getting back into it.
Thanks, Lindsay. Yeah. Let's have a very quick look at the markets before we go. Oh, we're going to do that right after the break. We're going to check out MTY Food Group. That stock jumping on a report that is looking for a potential buyer. We'll be right back. Let's have a very quick look at the markets before we end our show. And we have seen some pressure on the big North American indices. There's MTY Food Group, though, jumping. Reuters reports that owner of food court restaurant brands has hired TD Bank to explore a sale. MTY wouldn't comment, and TD Bank wasn't talking. It has an empire spanning more than 80 different banners, including Famous Dave's, Mr. Sub, and Wetzel's Pretzels. So you can see that stock jumping on takeover speculation. Let's have a look at the big North American indices right now, because they are in the red, and it hasn't been a bad year, though. S&P still up about 14% this year, and the Toronto Stock Exchange up around 22%. The Nasdaq, though, has been suffering over the past week or so, and it's now up only about 18% in 2025. Thank you very much indeed for watching Trading Day.